It's that time of the year again, the final month before the end of the financial year, and of course that means that now is the last opportunity you have to make those final superannuation contributions. And there are plenty of reasons why you'd want to do this. For most people, it's a really good way to save some tax, and that's primarily what we're going to be focusing on in today's video. But there are some other reasons as to why you want to make some last minute super contributions, and that might include the government co-contribution, or maybe you simply just want to transition some assets into a tax-free pension. And we'll touch on those other areas a little bit in this video as well. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about last minute superannuation contributions. Firstly, let's start off by looking at the tax saving that superannuation can offer us. So if you're below the age of 67, you can make a tax deductible contribution into your superannuation. Now, if you're between 67 and 75, then you're gonna need to meet a work test, which is you have to work 40 hours in a 30-day period in order to make that same contribution. And if you're over the age of 75, well, unfortunately, this door has closed for you. And the reason why you want to make a tax deductible contribution is obviously because it's going to reduce your tax liability. And let me give you an example of how this may work. Let's say you earn $100,000 per year before tax, and you have no other investment income and no deductions. Throughout the year, you should have paid $24,187 in tax through your PAYG system. When you lodge your tax return, you don't have any additional income to declare nor deductions to claim. And as a result, you will not owe anything to the tax office, nor will you get a tax refund. The PAYG was spot on and you're all squared with the ATO. In the same situation, let's assume you make a $10,000 tax deductible contribution to superannuation. In this instance, you still would have paid $24,187 in PAYG tax throughout the year, but now you can have a $10,000 deduction to claim. As a result, the ATO will calculate that you've paid $24,187 in tax, but you only owe them $20,437. So you're gonna get a tax refund of $3,750. Now, of course, everyone's financial situation is a little bit different, and the amount of tax refund you get is gonna vary depending on a number of factors. But what this basic illustration does show is that making a tax deductible contribution to superannuation is a beautiful thing. Not only will you save money in personal income tax, but when the money goes into your superannuation fund, it's going to get invested and then the compounding begins. But of course, like with everything in finance, there are some restrictions that you need to take into consideration, and there are also some potential downsides that you need to be aware of as well. So let's first of all jump into those restrictions. As we've already touched on, there are age restrictions in order for you to be able to put money into your superannuation. On top of those age restrictions, there's also what's called contribution cap limits that you need to work within. A tax deductible contribution is a type of concessional contribution, and that has an annual cap limit of $25,000 in the current financial year. Now that cap limit is increasing to $27,500 next financial year. But bear in mind that any employer contributions or any salary sacrifice contributions will also form part of your concessional contributions cap limit. So before making any additional tax deductible contributions, you should be getting in contact with your superannuation fund and asking for the total concessional contributions that have already been made in the current financial year. And of course, you also need to account for the contributions that potentially are going to come into your superannuation fund before the 30th of June. And the way you do this is you basically have a look at your transaction history in the past, you see when the employer contributions and the salary sacrifice and things have come in, and you estimate based on the previous amounts and the previous dates as to what is a likely contribution that's going to be made from your employer in the remainder of the financial year. You also have the ability to utilize any carry forward unused concessional contributions. So from 1 July 2018, if you haven't maxed out your cap limit, you can carry forward the remainder of that limit for up to 5 years, provided that your superannuation balance is less than $500,000 on the 30th of June in the previous financial year. The easiest way to find out how much carry forward concessional contributions you have available is to log onto your MyGov account, click on your linked ATO services, select Super up the top. Under Information, you're going to find carry forward concessional contributions. Assuming you're eligible to make a tax deductible contribution and assuming you have enough space left in your concessional contributions cap, then there are still a number of things that you need to take into account before making any contributions. Firstly, it's important to note that concessional contributions are taxed by your superannuation fund at the super rate of 15%. Now, if you earn less than roughly $20,000 in your personal name, then it's probably not going to be tax effective to make these types of contributions to your super because you don't pay any tax outside of super anyway. So the way you calculate your net tax saving is you get your marginal tax rate, you take away the superannuation rate, and you times that by the contribution amount. And that's essentially going to give you your net tax saving. If you're fortunate enough to earn over $250,000, then you're also going to get slugged with Division 293 tax. Now this is basically an additional 15% tax on top of the standard tax on concessional contributions of 15%. So it effectively takes your tax rate on concessional contributions up to 30%, which is not ideal, but at the end of the day, if you're earning this kind of money, your marginal tax rate is going to be 47% when you include Medicare levy. So there's still a tax saving there because you're comparing 47% in your personal name to 30% at super. Once inside superannuation, you're not going to be able to access those funds until you meet a condition of release. Now, the most common condition of release is meeting preservation age. And if you were born after 1 July 1964, your preservation age is age 60. There are, of course, other ways you can access your superannuation, such as financial hardship, but I'm not going to go into everything in detail in this video because it's a whole new topic and it's a big topic, but just know that your contributions are likely going to be in there until you meet preservation age. And of course, before making any contributions into your superannuation, you need to understand how those funds are going to be invested. So I always say to people, treat your superannuation like you treat your own money in your own name, because at the end of the day, it is your money for your retirement. So you should be comfortable with how it's invested, you should understand how it's invested, and if you don't, well then regardless of the tax saving you get, you probably shouldn't be making extra contributions if you're not confident with what the money's going into. So you have until the 30th of June to get these final superannuation contributions in. But bear in mind that the date at which it counts towards your concessional contributions cap is the date at which it's received by the fund and processed by the fund. It's not the date at which you send your money. So with this in mind, we always recommend it's best to get those final contributions in before the 15th of June. Making the contributions really easy, all you need to do is call up your superannuation fund and ask for the banking details. Now most super funds will let you do it via either EFT or BPay, and they'll also give you a reference number to ensure that it's allocated into your account. Once the contribution's in, it's time to fill in a Notice of Intention to Claim form, which can be found on the ATO website. By completing this form, you are letting your super fund know that you intend to claim a tax deduction for the contribution, and therefore your superannuation fund will allocate it as a concessional contribution. Upon processing the form, your superannuation fund is then going to send you out an acknowledgement of the Notice of Intent, and this is a little letter that you can give to your accountant which proves that you've made a contribution or a tax deductible contribution to your super and you can claim it in your tax return. And that's it, you've successfully made a contribution, you've had it allocated properly, and you're ready to claim your tax deduction. And if you go through this process, you're going to thank yourself twice. You're going to thank yourself once when your tax bill shrinks, and you're going to thank yourself later in life again when your retirement balance looks a whole lot healthier. As I touched on at the start of this video, there are other reasons why you might want to make a last minute superannuation contribution other than the ability to claim a tax deduction. And a few of those other reasons, in brief, are as follows. The government co-contribution. If you earn less than $39,837 and you make a $1,000 non-concessional contribution into your super, you may be eligible for a $500 government co-contribution. If you earn between $39,837 and $54,837, you may receive a reduced government co-contribution payment. Eligible spouse contribution. So if your spouse earns less than $37,000 and you make an eligible spouse contribution of $3,000 into their super fund, you may be eligible to claim a $540 tax offset. And the transition of assets into super. As you approach retirement, it's often a good idea to utilize your super to house majority of your retirement assets, as it can be held in a tax-free pension account. Under this scenario, you'd look to utilize non-concessional contributions and potentially the bring forward rule to make large contributions into your super. But that's it for me today, guys. Thanks a lot for watching. If you did like this video, please give it a thumbs up. And if you are planning on making any last minute superannuation contributions, then you should probably get cracking on it, because the 30th of June will be here before you know it. But that's it for me today. I will see you guys in the next one.